Well, hello everyone. Last video lecture today. Okay, you'll have video lectures Tuesday and Wednesday, but those are reviews. So this is it for the new stuff. And appropriate that we're going to be talking about investing and retirement, because I know that's something that many of you are interested in, which is why there's a bull and a bear in the picture there. And just to keep that theme going, there we go. So you've probably heard those terms, bulls and bears. If you're bullish on a stock or it's a bull market, that means the stock market's going up. You feel good about it. But if you're bearish about a stock or the market's going down, it's called a bear market. Do you know why they use bulls and bears for those descriptions? Well, if you look at this in the top right, that there you see those arrows? When a bull attacks, it takes its horns and lifts up. It lifts up. And when a bear attacks, what's it do with its paws? It claws down. Claws down. So that's why a bull market is a market that's going up, and a bear market is one that's going down. So if you hear those terms, that's why they came up with it. All right. So let's take a look at what we have coming up, and then we'll move into the chapter. Okay, so Chapter 14 quiz this Wednesday at midnight. That's the last one. You knock that out and you're done with the quizzes. And then your team member evaluation for the business plan also due Wednesday at midnight. Those are required, so please get those in. The final exam, okay, that's next Monday, and between 2 and 6, and it'll be via Blackboard. So you just log on to Blackboard, and you'll have 2 hours to complete it, okay? And then, of course, the next 2 days we'll be doing reviews, video reviews. I'll be sending out a video tomorrow on chapters 8 through 10, and then Wednesday's video will be a review of chapters 12 through 14. It'll feel very much like when we were outside for that class and we reviewed for the midterm. It's going to have that same feel coming up. Obviously, if you have questions on any of that, just email me. And so with that, let's get into today's chapter. Stock market. So let's start with some investing basics. Stock prices are based on many factors, okay? Most principally, earnings and expectations. Earnings, how much a company is making. Obviously, that's important. And expectations, what you expect the company to be making moving forward. Okay, so it comes down to supply and demand. Take a look at 2 companies, Tesla and GM, and that's going to show you the importance of expectations in stock prices. In 2019, Tesla's revenue was about $25 billion, give or take. GM's was more than 5 times that, $137 billion. But guess which company is worth more? Tesla's worth more. Their market cap of about $130 billion is more than 4 times GM's market cap of about $31 billion. Think about that for a minute. GM had revenue of more than 5 times what Tesla's in. But Tesla is worth substantially more. Why? It's all about expectations. Obviously, the earnings are more for GM, but people think, you know what? Tesla is the future. Obviously, they have the electric cars. That's the future. They've got the technology. They've got the battery. They've got Elon Musk, who people have confidence in. So the stock price of Tesla is worth more because people believe that in the future, Tesla's going to be worth more. Expectations are an important factor in stock prices. So why invest in stocks at all? Well, if you look at that purple lines on the bottom, that's why. Because over the long term, a diversified portfolio of stocks has proven to really outperform other investments. And I'm going to show you a couple of examples of that here. excuse me. So this is a Excel spreadsheet that you've seen before in Chapter 13. And it shows the annual returns of the S&P 500 stocks versus T-bills or CDs and bonds, okay, going back to 1928 every year. And over here it's going to show the value if you invested $100 in each of those investments in 1928, when really the S&P 500 and its forerunner started, all the way up to the present. Okay? So we're going to go all the way up through 2019. And it shows that stocks, if you reinvested your dividends, returned an annual average of 9.71% versus 3.35 for T-bills and 4.88 for bonds. Okay? But the important thing is, if you invested $100 back in 1928, in stocks you'd have just over $500,000. If you were in those T-bills, you'd only have $2,000. In bonds, you'd only have $8,000. So even though these seem relatively close, look at the difference. And that's due to compound interest in the time value of money. Okay, what we've talked about. That's why it's so critical that you invest in stocks for the long term. You all have a long time to go before retirement. And that's the return you need to make a lot of money and to build wealth. Okay? It shows it in this, and it shows it one other place that I want to show you, and that's in a graph. Okay, let's see, this graph here. So this is just a graph of what I just showed you, the S&P 500. This goes back to 1928 when it started, right up to the present day, okay, April of 2020. So first, take a look at that graph, okay? You can see it goes up, right? And you are investing for the long term. So you can't see a single 40-year period where stocks went down, not one. I mean, here we are in April of 2020, go back 40 years to 1980, right? It went up a lot. Every 40-year period, it's gone up, and that is your investment horizon. Really, every 30-year period, it's gone up, and virtually every 20-year period, it's gone up. Okay? So even though you'll see it goes down, goes down, goes down, okay? This is the financial crisis of 2007-8, and went down. Here's the dot-com bust. Right here, it went down. But in the long term, which is how you're investing, you can get through that. Because in the long term, going back to 1928, right before the Great Depression, in the long term, stocks have always gone up. So I would tell you that the risk is not to be in stocks for the long term. The risk is not to be in stocks for the long term. You're investing for a 40-year horizon when you're going to retire. So my advice is that's where you should put your money. Okay? And even, let's just take a look at 30 years. So this was the tech wreck. This was the Great Recession. And look, we're well beyond that. This is the coronavirus right here. You can see how relatively little impact this has compared to these two, right? Compared to these two. Big difference. And again, the last 10 years, that's the coronavirus downturn, right? It's just in the broader scope, it just has not been that big of a hit to the stock market. There's the numbers right there in front of you. Okay? So, again, my advice for the long term, and the advice financial planners would give you, and financial experts, and we're going to hear from one today, is this is where your money should be. Okay? In stocks for the long term. Okay, so buy low and sell high. That makes sense, right? If you want to make money, if you buy something for $10 and sell it for $20, you've made $10, right? You don't want to do the opposite. If you buy it for $20 and sell it for $10, well, then you lost $10. So buy low, sell high. So how do you know when to do that? Well, my advice is use something called dollar cost averaging, okay? And all dollar cost averaging is investing the same amount on a regular basis. For instance, if you were to put in $200 at the end of every month, or some figure, whatever it is, that's the way to do it. And here's why. Let's say you were going to invest $200 at the end of every month. Okay? And at the end of month one, a stock you wanted to buy cost $100 per share. How many shares could you buy? Well, you have $200, so you could buy 2 shares at $100 a share. Let's say at the end of the second month, the stock fell to $50 a share. How many shares could you buy? Now you could buy 4 shares, right? Because you're still investing $200. So by investing the same amount every month, dollar cost averaging, you bought more shares when the price was low and fewer shares when the price was high. That's my recommendation to you, particularly when you get full-time jobs, is put some every month into investments. You'll be able to do that automatically with 401ks that we're going to talk about today. But I'd suggest the same thing for your saving. Put some amount every month into your investments. And today we'll show you how to do it. It's called dollar cost averaging. Okay? And then finally, the active versus passive investing. That's really the two ends of the spectrum. Active, market timing. You try to get in when the market's low. You try to sell and get out when it's high. That's one end of the spectrum. The other end is passive. Just buying something and holding it, right? Don't try to time the market. Buy and hold. And then there's all sorts of room between those spectrums. But I'm going to suggest that you get much closer to the passive end of the spectrum. Buy stocks on a regular basis and hold on to them. Don't try to time the market. And I'm going to show you why. The difficulty of timing the market. Almost all big stock market gains and drops come in just a few days each year. And this is a really good illustration of it. So this is a 20-year period from January 98 through December of 2017. 5,036 trading days, okay? And if you invested, whatever, $10,000 here, you would have seen a 7.2% return. Not bad, okay? Not the 9 we've been looking at, but look, it's this 20-year period that had both the dot-com downturn, okay, it got that, and it also had the Great Recession in it. Even with those two big hits, it still returned 7.2% stocks. That's fine. You can do just fine with a 7.2% return. But look, if you just missed 5 days, the 5 biggest days out of 5,000, look what happened to your returns. It went from 7.2 to 5. Massive drop by missing 5 days. If you missed 10, look at that. Your returns were more than cut in half, right? 3.5. If you just missed 10, the 10 best out of 5,000, and all the way down. If you missed 20, you basically were investing in T-bills, and if you missed the top 40, you lost money. So it's extraordinarily difficult to know when to get in, when to get out, okay? And as long as you don't sell when the market is down, you can weather the losses. Think about what would happen if you bought a $100 backpack, okay? Yeah, just spent $100 on a backpack. And 6 months later, you think, you know what, I'm going to sell this on eBay. I don't want it anymore. The price went down to, say, $75 and you sold it. What was your net gain or loss? Well, you lost $25, right? You bought it for $100, went down to $75, you sold it, you lost $25. Now, let's look at that same scenario. You bought it for $100, you thought about selling it in 6 months when the price went to $75, but you said, I'm not going to sell it yet. Now, let's just say the price went up 6 months later to $125. Maybe some cool features on your backpack, not on others. Now you sold it for $125. Did you make or lose money? You made $25, right? You bought it for $100 and you sold it for $125 a year later. The fact that it went down to $75 made absolutely no difference to you because you didn't sell it then. right? It's the same thing with stocks. As long as you don't sell it when the stocks are at a low point, it makes no difference to you. It doesn't impact you. It only matters when you sell it. So the fact that the stocks go down some years, some months, has no impact on you if you're holding for the long term as you are in retirement. Another example that really speaks to the same thing, this is over a 30-year period, okay? And let's take a look at this. If you miss the 25 best days over a 30-year period, look what happened. Your returns were actually less than 5-year treasuries, right? If you kept the money in the market, here's how you did. The black line, pretty darn good. If you missed the 25 best days, you're the red line. See? You were actually below 5-year treasuries, which is nothing, right? By missing 25 of the best days out of 30 years. So again, my advice is that you buy on a regular basis and you keep your money in the market. People have a tendency to get frightened and they sell at the worst time. They see the market goes down a little. Oh, I'm getting worried. Goes down more. I'm more worried. Goes down more. Okay, I can't take any more, and they sell. What have they done? They've sold at the worst time. The market's going down, 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 and they've sold. Worst thing you can do, because then you've locked in your losses. You've sold your backpack at 75. And when do they get back in? They say, oh, I'm not going to get back in until it's safe. What's safe? The market goes up a little. Okay, I feel better about it. Goes up a little more. Feeling better. Goes up a little more. Okay, now I feel it's safe. When are they buying? Now the market's high. It's gone up, 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 up. Now they're buying. Again, they're buying high. They sold low and they're buying high. It's the worst thing you can do. But human nature, that's what some people will tend to do. And I don't want you to do it because that's a recipe for losing money. Okay? So I'm going to recommend that you're going to buy an index fund that tracks the S&P 500. I'm going to show you how to do that in a second and hold on to it. And it's not just me saying that. It's financial planners and Warren Buffett, the greatest investor of all time, okay, the owner of Berkshire Hathaway. I'm going to pull up a video here. It's only 3 minutes long, and I want you to hear from his mouth what he says. Okay? The first minute and a half of this, he's talking a little bit about his annual meeting for Berkshire Hathaway, and this is from 2018. So he talks a little bit of how the meeting went. He talks a little bit about his partner, Charlie, and Charlie's 96. Warren's going to be 90 this year. He's kind of a curmudgeon and a funny guy. So Warren talks about that for a minute and a half. Then he talks about index funds. And it's just illuminating to hear from probably the greatest investor who ever lived and hear what he has to say. So let me bring this up.
I think everybody had as much fun as ever. I mean, we had a crowd that certainly equaled our record. And again, I run into thousands of shareholders, and they're all having a good time here, and our directors have a good time. So it's just sort of a Mardi Gras.
Was there anything different about this meeting, or is it the sameness that makes it so special?
It's the sameness, pretty much. I mean, working with Charlie Munger, we're not going to change the format very much.
Although Brian pointed out earlier that there were a lot of kind of controversial subjects, a lot of things that caught people's attention and picked up a lot of news this time, and it's because you and Charlie would say what you think, especially Charlie.
Yeah, Charlie says exactly what he thinks, and he thinks in colorful language too. Have you noticed that?
I've noticed that. Has that changed over the years, or is that just more the same?
That's Charlie.
Yeah, that's Charlie, and since you met him?
Since 1959, when I met him.
Okay. Warren, let's talk about some of the things that really resonated with people, and maybe start where you began the annual meeting this year, and that was talking to your investors and telling them a little bit about investing, some tips and lessons along the way. You kind of used it as a teaching experience at the top.
Yeah, normally I don't do that. I mean, in fact, I can't remember when I did it. We just go right into questions and answers, but I really thought that maybe we were giving a little bit the wrong lesson. Because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
So, there it is. You really can't say it better than that. If you had invested $10,000 when he bought his first stock in 1942 in an S&P 500 index fund, it would be worth $51 million in 2018. It's the exact same thing we just showed you. If you're investing in an index fund in the S&P 500, you just let it go. You don't have to worry about things that happen. And that's been the truth for the last 90 years, which is how far the data goes back. So I'm going to show you next how to go about doing that. So mutual funds, index funds, and ETFs. So we're going to talk about those. Now, we've gone over it before. I want to talk a little bit more specifically about them now. Mutual funds are simply investments that pool your money together with other investors that purchase shares of either stocks or bonds or other securities. That's all they are. You send your money in, other people send their money in, and these funds buy baskets of stocks or these other securities, and if that basket returns, say 10% at the end of the year, you get a 10% increase. That's how it works. Index funds are mutual funds. They're just a subset of mutual funds. Index funds track an index, such as the S&P 500. Okay, we talked about indexes. The Dow Jones is an index. The S&P 500 is an index. The NASDAQ Composite is an index. That's all index funds are. They're just mutual funds that track an index. Okay? But the reason mutual funds are great to invest in rather than individual stocks is because you get diversification, which means you're buying a whole bunch of stocks. You're not tied to just one or two or a few stocks. A lot more risk in that. You get diversification. You're investing in a lot of them. The cost, very low. I'll show you that in a second. And it's convenient because you don't have to worry about which stock to buy. You're buying a massive basket of stocks. You're buying a bunch of them. So diversification, low cost, and convenience are great reasons to buy mutual funds, specifically index funds, not individual stocks. So let's take a look at some mutual funds. And I'm going to use Fidelity as an example here. We're going to go through on the next slide that there are different stockbrokers. Fidelity's one, but they've got a good website, so I'm going to use them. So this is their mutual fund page, okay? And here's different categories they have of mutual funds. So they have domestic equity funds. Do you want to invest in large cap stocks? They're big stocks. Do you want to invest in small or mid-sized stocks? Ones that focus on income, a blend of stocks, small mid-blend, go anywhere, large growth stocks, small growth stocks, all sorts of different stocks, women's leadership fund stocks, right? International equity, let's say you wanted to do global stocks. Look at all the different options you have for global stocks. All global stocks, China, emerging Asia, Europe, Latin America, Nordic, right? All sorts of different global mutual funds? What if you wanted to just buy, oh, I don't know, maybe a different sector, you wanted to focus on that? I like communications, or consumers, or energy stocks, industrial, real estate stocks. I mean, look at all these different stocks. Healthcare, IT. All of these are mutual funds. There's thousands of different mutual funds. Fixed income are just bond funds. The exact same thing, only they're bonds. And again, look at all the different types of bonds: corporate bonds, mortgage bonds, government bonds, short bonds, high yield bonds, right? Municipal, state bonds, Maryland, all sorts of bond funds. Money market, okay, these are CDs, short term investment bond. There's mutual funds on these as well. And then here's asset allocation funds. You might hear that this is where you want to put your money. Here's how these work, okay? Look, freedom for each 5 years going up to 2065. So a Freedom 2065 fund is just for people who would retire in 2065, like you. And the reason Fidelity has these is the thought is you don't have to do anything with it. That is, you get older, Fidelity moves more of your money from stocks into bonds and cash. Because the closer you get to retirement, the closer you get to needing that money. So money should be more in bonds and cash as you get closer to retirement. Sounds great, right? You put the money in, you don't have to worry about it. Here's the problem with these type of funds, why I don't like these type of funds. Right now, and here's the 2065 fund that you would do, because that's more or less when you would retire, it's about 90% made up of stocks. Makes sense, right? So 50% domestic stocks, that's ones in the U.S., and another 39%, so 90%, 50 and about 40, are in stocks. These are international stocks. And only a little bit in bonds, 6% in bonds, and a little bit in cash. As you get older, that would switch. Instead of the 90, this would go to 85 and 80 and 75. But here's the problem with these. Look at the cost of this. $7.50 per thousand. Just keep that in mind. 0.75 cents. Okay? And here's why I bring that up. Because I want you to put your money in an index fund. Okay? And for Fidelity, here's a Fidelity 500 index fund. It tracks the S&P 500. That right there. I would suggest putting it, if you're in Fidelity, there or in this one. 0 total market index fund. It's not just the 500 biggest stocks, it's the entire market. So the difference is, even though this is mostly large stocks, S&P 500 stocks, it also has some mid-cap and small-cap stocks. Okay, so about 25% of this is mid and smaller stocks, whereas all of this is big ones. Okay, but either one would be great. So let's take a look at the Fidelity 500 S&P 500 index fund. Okay, composition is stocks, right? We knew that. It's going to be 100% stocks. Look at your biggest stocks. Recognize those? Microsoft, Apple, Amazon, Facebook. There's Warren Buffett's Berkshire Hathaway. A quarter of the portfolio, okay, is those companies, those big companies. And it's all stocks. Okay, look at the returns. Over the last 10 years, 10.5%. Pretty good, right? 10.5%. You'll take that. But look at the fees. This is the important thing. Look how cheap. Okay? 15 cents per thousand. Remember what the other one was? $7.50 per thousand. The fees are substantially more, 50 times more. 15 cents versus $7.50. 50 times more. This is where you want your money. You're smart enough to know, hey, we should have all of our money in stock. We're only 20, 25 years old or whatever, age some of you are. You could move it in 10, 20, 30 years, a little bit into stock. You don't need to pay them 50 times the amount to do that, right? It just makes no sense. So I think this is where you should have your money, in an S&P 500 index fund, and that's Fidelity's index fund. And the other one that I pulled up, so I showed you the Fidelity 500 index fund. That zero total market index fund, let's take a look at this one. This is the entire market. It's going to work very much like the S&P 500. The returns will be similar. Okay, but let's look at the fees for this. How's that for a fee? Fidelity has 0% fees. That's why it's called a zero total market index fund. You don't pay a dime for this fee. I don't know how you can beat that, right? So that's what I would recommend. An S&P 500 index fund or a total market fund. Either one. Okay? Either one. Okay. So, mutual funds, specifically index funds, I think that's where you should put your money. Okay? Now, what's interesting when you look at index funds in general is that the largest mutual funds, these are all mutual funds, most of the largest mutual funds in the world are those that are index funds. Here's the largest. Vanguard 500, okay? S&P 500, total stock market index, 500, 500, total stock market, total stock market, total stock market, okay? S&P 500. Most of the largest funds in the world are index funds that track the S&P 500 or the total stock market. There's a reason for that. They're smart investments, and I think that's where you should be. Now I want you to look at three things here because we're going to talk about an ETF next, an exchange-traded fund. And look at this, the second largest mutual fund in the world, SPY, is an ETF. The eighth largest, IVV, is an ETF. And the 16th largest, VOO, is an ETF, all that track the S&P 500. And here's why I'm speaking specifically to that. If you're an international student, okay, if you're a non-U.S. resident, you won't be able to invest in mutual funds. Okay, there's SEC securities laws that make it very difficult for these companies like Fidelity to regulate mutual funds for overseas investors. So most companies don't allow non-U.S. residents to buy mutual funds. So you can buy an ETF, an exchange-traded fund, which is not really essentially nothing more than an index fund that trades on an exchange, like the New York Stock Exchange. Okay? It works the same way. It's a basket of securities that tracks an index like the S&P 500. And those three I showed you, this one, and this one, are all great funds. They're huge funds. The SPY is State Street Global Advisors. Okay, the VOO is a Vanguard fund, and the IVV is an iShares fund. Okay, that's BlackRock. So three massive companies, and they just sponsor these funds. So if you're an international student and a non-U.S. resident or a non-U.S. resident, this is what I would recommend. Invest in an exchange-traded fund that tracks the S&P 500. Okay, so how do you do that? Now that you've talked about this is what we should invest in, well, how do we go ahead and do that? Well, you have to go through a stockbroker, and these are some of the largest, most well-known stockbrokers. Take a look at some of these names. So I'm sure you've heard of these, okay? And you open an investment account really the same way you open a bank account. It's no different. You just go online and you open it. Because we're speaking to Fidelity, I'm just going to go to theirs, but you could use any of these. Okay? It's really as simple as this. Just open an account. You just click on this, and really, off you go. You would open a brokerage account, the Fidelity account right there. Okay? Whether you're investing in an ETF or a mutual fund, index fund, just click on that, and just off you go. It doesn't cost anything to do it. If you have any questions, look, just pick up the phone and call them. It's free. So I recommend everybody do it. Open up your individual stock account today or soon. It doesn't have to be through Fidelity. It can be through any of those. This is just the Fidelity page. It couldn't be easier. You go through this. It's free. If you have any questions, you pick up the phone and talk to somebody. I find the Fidelity people very helpful. And you could put nothing in. You could put something in. you can tie this to your checking account, so you just automatically online say, okay, you're tied to my checking account. I want to move in 100, 500, 1,000, whatever you want to move in, you just can do it automatically. So I certainly recommend that you do this. Again, it's just like a bank account. You can move money in or out anytime. Okay, most of these are free to open. Most of them have no minimums. Okay, and we showed you how inexpensive it is for those funds. So again, I recommend doing this. Okay, and you can take a look at all these. If you'd like, and you're not sure which one to do, you can go take a look at our friends at NerdWallet that we talked about. They review different stockbrokers and say, here's what we think is good and bad about all of them. And look, here's pretty much the ones we just went over. Okay? I don't know much about these, so I'm not recommending them. But these, well, actually, Schwab is in the process of buying TD Ameritrade. Charles Schwab is going to buy TD Ameritrade, so this will eventually become Schwab. But just click on these. Okay? Read a review, read a review, read a review, and you'll get the thoughts of NerdWallet on each of these. But look at the cost. None, 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 0, 0, 0, right? There's just no reason not to go ahead and open up an investment account and get started. And it's really as simple as that to do that. Okay, simple as that to do that. Okay, so let's move on, because we've talked about now investment planning. Let's talk about retirement planning a little bit. Okay, and you've heard the term 401k, so let's talk about what that is a little bit. It's simply a retirement plan that's sponsored by your work, an employer. You can't get it on your own. For most companies, you've got to be full-time. Not all, but most. So once you get a full-time job, you'll have the opportunity to invest in a 401k. And I think it's a good idea to do it. Most people will say it's a good idea to do it. There's lots of good reasons. Let's go through some of them. You can invest up to $19,500 a year. It's up to you how much you want to invest. Anything up to $19,500. Your contributions are pre-tax, which means they're going to take those out before tax comes out of your paycheck. So you're saving a bunch of money there, right? It's not like tax comes out and then you invest. The money comes out first before taxes. So it's great. Many employers match some or all of what you put in. Okay? You can't beat that. Many, employers will match something up to, many of them will do up to 5, 6, 7, 8,000. It depends on the employer, but that's just free money. Lots of investment options, so you can invest in an S&P 500 fund. Okay? Fidelity and Vanguard are the two biggest sponsors of these funds. So if you work for a company, they'll say, okay, we've got a 401k plan. We use Fidelity or Vanguard. Okay, so here's the web portal, and you have the investment options here, and they're all going to have an S&P 500 index fund or a total stock market fund. You can put your money right there. Okay, painless. You can deduct it automatically. You can say, you know what? I'm going to take out $200 a month. You'll never even see the money. Okay, it just comes out before your paycheck. So it's easy to do, which means you can dollar cost average it. Just say the same every month. Okay, if you do declare bankruptcy, hopefully you'll never do that. Your 401k is protected from creditors. Okay, and I don't want you to do this either. You can take loans or hardship withdrawals if you absolutely need the money. It is possible, but you don't recommend it. Okay, you can only take out a certain amount. You have to pay it back. If you do withdraw early, there's 10% penalty. It's a lot. So you should know that the option is there, but certainly it's not recommended. So 401ks are really an excellent vehicle to help you save for retirement. And once you have the opportunity to do it, I certainly recommend that you take advantage of a 401k. And then lastly, another retirement vehicle is an IRA, which stands for Individual Retirement Account. You don't need a company to do this. You can start this on your own. Okay, but you can only contribute $6,000 a year as opposed to the $19,500. So if you want to start an IRA, it's fine. Start an IRA, okay? You've probably heard Roth IRA and traditional IRA. What's the difference between the two? Well, let's talk about it. A traditional IRA is best if you think your tax rate's going to be lower now or lower in retirement than now. And that's what it's going to be for most people, because when you retire, you're probably not, bringing in any money, so you'll have a lower tax rate. So for most people, a traditional IRA is the right option. And your funds aren't taxed till you withdraw them, which means when you put money in, say, okay, I can put $6,000 in this year, you send $6,000 into Fidelity or Vanguard or whoever, then you can deduct that on your taxes. So that's good. Okay? And it is a retirement account, so if you take money out, it's going to be penalized. So you don't want to do that. This is money that's put aside for retirement. A Roth IRA works very much the same way, but your contributions are made with after-tax money. Okay? If you expect your tax rate to be higher in retirement, okay, you'd rather be taxed now, not when your tax rate is going to be high in retirement. Okay? So in that case, you just do what's called a Roth IRA. Again, it works the same way. Okay? You can put in up to $6,000, but you can't deduct it on your taxes this year. When you take it out, you don't pay taxes because you're paying taxes now. Okay? So that's really the main difference. There are income limits for the Roth IRA. If you make a lot of money, you can't use this. Okay? You're just not allowed to because it can act like a tax shelter for people that make a lot of money. So once you start to make a lot, this gets phased out. You're not allowed to do it. Okay? So that's essentially what an IRA is. It's a retirement account where you're putting money away now for retirement. Okay? So with that, let's kind of summarize what we talked about for these last 3 videos. Okay? We've talked about personal finances, really looking at a lot of different areas. And if you were to ask me what's the most important things we went over in those 3 classes, here's what I'd say. First, pay yourself first starting now. Okay? Starting now. Don't wait because tomorrow never comes. Start saving now. Allocate money to savings and investments, right? We talked about with savings, you want to have 3 to 6 months in savings. Once you've got that, then you can start putting money in investments. And given the time value of money and how those investments can grow, the sooner you can start, the better. Open up an investment account today with one of those stockbrokers. Put some money in now. If you can put money in every month, great. If you can do it as soon as you start a full-time job, great. But obviously, the earlier, the better. Pay your credit cards on time in full every month. Okay? That was the lesson we went over in our last chapter, in our last lesson. Remember, the way the time value of money works for you in investments can work against you with credit cards. Invest in an index fund or ETF that tracks the S&P 500 rather than individual stocks. So what we talked about today, that's my advice. That's where you should invest. That's what Warren Buffett says. That's what many financial planners will tell you. It's particularly for a young person. It's really what makes the most sense. Okay? And then contribute to a 401k when you're able to do that. Once you have a full-time job, you should do it. It's a great account. The tax advantages work to your advantage, as do all those other advantages we went through. Ultimately, it comes down to willpower. Willpower. Okay? We talked about spend less than you earn. Pay yourself first. You got to put that money away. If you do that, you're going to build wealth. You just will. It's math. I hope with all we've talked about in these last 3 lessons, we've convinced you. It is absolutely doable. It's absolutely within your power. Okay, you need 3 things to get rich. Time, you've all got it. Return, we just showed you the best way to get it that many financial planners, Warren Buffett and I am telling you. An index fund that tracks the S&P 500 or the total market has proven over time to be an extraordinarily sound investment. That leaves just one, and that is Willpower, it's you investing some amount of money on a regular basis. And the more you can do, the better. So as long as you have that willpower to save and invest, you should be in good shape. You should be able to build wealth. So with that, as always, if you have questions on anything, just email me. I'm happy to answer any questions you have. The next 2 days, Tuesday and Wednesday, we'll be doing reviews. Okay, tomorrow, review of chapters 8 through 10, and then Wednesday, review of chapters 12 through 14. So with that, everyone, stay safe, take care, and we'll be in touch tomorrow.